In this lecture, we discuss issues relating to estimation of the cost of capital. In the first lecture, we spent considerable time on free cash flow to the firm valuation. We estimated a set of cash flows available for distribution to the providers of capital, that is the debt and equity holders, and we discounted those cash flows at the weighted average of cost of capital. In this class, we consider specific issues in relation to each component of the weighted average cost of capital. We also discuss issues of internal consistency in the discount rate. This means that each parameter in the weighted average cost of capital should be estimated with consideration of all the other parameters. For example, you cannot estimate the cost of equity without consideration of leverage or debts to value, because all else equal, leverage increases the required return to equity holders. You also need to consider the cost of equity jointly with the cost of debt. If debt holders require high returns at a particular point in time, chances are that equity holders also require above normal returns. The cost of debt will also be influenced by leverage, because more leverage increases the risk of default. Before beginning any technical discussion of estimation issues, be mindful that the concepts discussed here are equally applicable to entire firms, divisions and projects. We also need to make clear that the cost of capital should reflect the specific risks of the firm, division or project being considered. A project does not have a higher or lower cost of capital merely because it is owned by a different firm. If this were true, we would not see such a disparity of different sized businesses. Almost all projects would eventually be owned by large listed companies because they have the lowest cost of capital. Large listed companies are not willing to pay more money for projects merely because they are large listed firms with access to cheaper capital. However, in assigning different discount rates to different divisions and projects within a firm, we need to be mindful of estimation error and incentives. While in theory every project has its own cost of capital, we are generally in a position of having to estimate that cost of capital with respect to listed firms. This entails substantial estimation error. You need to be mindful not to take the every project has its own cost of capital idea to extremes, because you could end up assigning a low cost of funds to one project and a high cost of funds to another project purely because of estimation error. There is also an incentive problem with this approach, which is one reason why some large firms assign the same cost of capital to all projects. They want to take away the incentive for managers to lobby for a low cost of capital to be assigned to their particular division or project, thereby focusing on cash flows and risk management, rather than discount rate estimation. It also means that projects are evaluated without the potential distortions associated with discount rate estimation error. Managers can isolate more easily why one project has more value than another on the basis of cash flows and risk management. Let's start with consideration of the cost of equity, and in particular the capital asset pricing model. The most commonly used equation for considering the cost of equity is the capital asset pricing model, which was developed almost 50 years ago as a theory of expected returns. The model says that the expected return on a risky asset is the sum of the risk-free rate of interest and a premium for bearing systematic risk, also termed market risk or economic risk. That systematic risk premium is the product of the market risk premium, which is the expected return on the market for all risky assets above the risk-free rate, and beta, which is a measure of the asset return's exposure to market risk. A source of considerable confusion in corporate finance practice arises because of the difference between the capital asset pricing model as a theoretical concept and the manner in which we often estimate inputs into the model. The capital asset pricing model was developed under the assumptions of a perfect capital market. The best way to describe a perfect capital market is one in which there are no impediments to trade. So the normal market frictions we encounter, like taxes, transaction costs, differences in information amongst investors and illiquidity, do not exist in a perfect capital market. In this frictionless market, there is no benefit from gathering proprietary information because all information is fully reflected in market prices. In other words, the market is efficient. This means that the only manner in which an investor can improve the risk-return trade-off of the investor's portfolio is through diversification. If you hold a portfolio that is less than fully diversified, all you do is expose the portfolio to asset-specific risk without any additional expected return, because there are no gains from gathering your own information. If all market participants hold fully diversified portfolios, then portfolios aren't exposed to asset-specific risks. The only risks that will be incorporated into market prices, and hence into the cost of capital, will be overall market risks. That is the theory behind the capital asset pricing model in relatively simple terms. It is a theory that provides a useful framework for thinking about risk and opportunity cost. But clearly we do not operate in a perfect capital market, and theory also tells us that market frictions leave open the possibility for risks other than market risk to be incorporated into the cost of capital. The challenge with incorporating other risks into the cost of capital has been that there has not been a consensus amongst academics as to exactly what additional risks should be incorporated into required returns, and how those additional risks should be measured. In practice, the issue is not whether the assumptions that underpin the capital asset pricing model hold in reality. Of course they don't. We do not have a perfect capital market. Rather, the issue is whether real-world market imperfections are so great that the capital asset pricing model does not approximately hold. Even though we are faced with market imperfections, it could still be the case that the model does a sufficiently good job of measuring the cost of capital for use in practice. A problem arises, however, because practitioners often fail to distinguish between the model as an equation and the estimation techniques that we use to estimate the parameters, that is the risk-free rate, expected market return, and beta. There are some standard techniques for estimating these inputs which often do a particularly poor job of estimating the cost of equity. So managers and investors will often debate about whether or not to use the capital asset pricing model, when what they should be debating is whether or not they can adopt better ways of estimating the inputs into the model. We will discuss these estimation techniques and their limitations in a subsequent section. But in short, the capital asset pricing model is typically implemented with the risk-free rate as the yield to maturity on long-dated government debt, beta from regressing stock returns on market returns, and the market risk premium estimated as an average of stock returns relative to government bond yields. If the capital asset pricing model is implemented in this manner, and without some careful consideration of the imprecision of this approach and the relationship between parameters, the result can sometimes be a cost of capital that is entirely unreasonable for valuation. It should also be noted that, while the capital asset pricing model is widely adopted in practice, this is largely because of convenience and the challenge associated with garnering acceptance for an alternative model. The capital asset pricing model has been tested for 5 decades with reference to realised returns, and it is clear that the standard way we estimate beta has little or no association with realised returns. The standard technique for estimating beta is to run a regression of stock returns on market returns using historical data. Depending upon the research study, there is either no association between the beta estimate and realised returns, or a marginal positive association between the beta estimate and realised returns. To illustrate the empirical evidence, consider the left-hand panel of Figure 1. The horizontal axis presents beta estimates for 48 industry portfolios, and the vertical axis presents realised excess returns. As you can see from the line of best fit, in this study, there is no association between beta estimates and realised returns. This figure is based upon 39 years' worth of returns from 1970 to 2008, with regression-based estimates of beta based upon 60 months of returns, a standard industry practice. The basis for the paper is that the researchers demonstrate that with adjustments to the beta computation, the CAPM might still hold, and this is a result illustrated in the right-hand panel. So it is possible that the capital asset pricing model may still be useful as a model for expected returns, but should be treated with caution if implemented simply by regressing stock returns on market returns to estimate beta. So it is arguable that the capital asset pricing model, in the way it's implemented in practice, is not particularly useful. But those tests themselves have an important limitation, in that they are tests of whether the beta estimate can explain actual returns. They aren't direct tests of whether the beta estimate can explain expected returns. So it remains possible that the capital asset pricing model, as implemented in practice, is a useful model for expected returns, but this has not been proven because we have not been able to directly measure expected returns. What we can say is that the capital asset pricing model, as implemented in practice, has not performed well at explaining realised returns. Let's consider the empirical evidence that calls the capital asset pricing model into question. There is an exhaustive body of research, known as asset pricing research, which encompasses both theoretical and empirical research. Research into asset pricing involves researchers trying to work out what leads to different assets having different prices, which also means trying to work out why different assets offer different returns to investors. According to the capital asset pricing model, we would expect stocks with high beta estimates to earn high returns, and there should be no other easily identifiable firm characteristics that are associated with stocks that earn different returns. The model says that only one type of risk, systematic risk, matters for asset prices and expected returns. But there are two main empirical results within a very large body of research that we know have persisted over time and across markets for decades. So we should consider this evidence when setting the cost of capital. First, stocks with high ratios of book value of equity to market value of equity earn relatively high returns. So we say that the book to market ratio is a firm characteristic that is suggestive of a higher cost of capital. The capital asset pricing model is an incomplete model of the relationship between risk and return. Secondly, stocks with low beta estimates from regressions of stock returns on market returns earn higher returns than predicted by the model. Stocks with high beta estimates from regressions of stock returns on market returns earn lower returns than predicted by the model. And this means that the expected returns from the capital asset pricing model are biased. We have two alternative asset pricing equations that are discussed below. These equations address the two key empirical results mentioned above. There are other empirical results that we don't have time to address in the class, but the key point is that the practice of relying solely upon the capital asset pricing model as the equation to estimate discount rates runs counter to 5 decades of empirical evidence across countries. The model is biased, incomplete, and it's imprecise. The capital asset pricing model is a useful way to think about risk. It makes us think carefully about risks associated with the market as a whole and risks that are firm-specific or industry-specific. It also makes us think about how the ability to diversify our portfolio changes the way we think about what risks matter to investors. But that usefulness does not mean that when it comes to the practice of actually deciding upon a discount rate to use in valuation, we should continue to adopt the capital asset pricing model as the only way to estimate a discount rate. The most well-known alternative asset pricing model to the capital asset pricing model is an equation developed by Farmer and French and published in 1993. This equation was developed in response to the observation that stocks with particular characteristics seem to earn relatively high returns on a consistent basis over time and across markets. We observed that small market capitalisation stocks earn higher returns on average than large market capitalisation stocks. We also observed that stocks with a high book value of equity relative to market value of equity, which we label high book to market stocks, earn relatively higher returns than low book to market stocks. Farmer and French developed the following asset pricing model because they wanted to establish that these returns were the result of exposure to risk factors, which are proxied by size and the book to market ratio. In other words, they wanted to show that small stocks and high book to market stocks are exposed to risks which affect asset prices for all types of assets, not just stocks. So they measured the returns to portfolios of small stocks relative to the portfolios of large stocks. This is the SMB factor for small minus big, and the returns to portfolios of high book to market stocks relative to the portfolios of low book to market stocks. This is the HML factor for high minus low. This is similar to measuring the returns to the market portfolio relative to the risk-free rate of interest. We can then estimate the exposure to these risk factors, just like we measure the exposure to systematic risk. The equation is as follows. Expected return equals risk-free rate plus beta times market risk premium plus S times SMB plus H times HML. Academics have not reached a consensus on exactly what the factors SMB and HML capture. There is a potential for risks associated with financial distress, asymmetric exposure to rising or falling markets, risks associated with arbitrage or other asset-specific risks to factor into expected returns. But this lack of a consensus on what risks are priced does not negate the result that some sort of priced risk appears to be proxied by the SMB and HML factors. So they are worth giving serious consideration in cost of capital estimation. Let's talk about the black capital asset pricing model. In the discussion above with respect to the capital asset pricing model, we noted that there is not a particularly reliable relationship between regression-based estimates of beta and realised stock returns. Stocks with low beta estimates from regression analysis have higher returns than predicted by the capital asset pricing model, and stocks with high beta estimates have lower returns than predicted by the capital asset pricing model. It was this observation that motivated research into alternative asset pricing models, including the Farmer and French model. Another alternative is the black capital asset pricing model. Under the black capital asset pricing model, the risk-free rate is replaced with the expected return on a zero beta asset, which is likely to be higher than the risk-free rate. It is a more general model than the Sharpe-Lintner capital asset pricing model we discussed earlier, because it does not rely upon the assumption that all investors can borrow and lend at the risk-free rate of interest, which is one of the components of a perfect capital market. The return on a zero beta asset is different to the risk-free rate of interest. It can have some risk, but no systematic risk. Both the risk-free asset and the zero beta asset are theoretical concepts. There is no asset that is actually free of all risk, the risk-free asset, or free of systematic risk, the zero beta asset. We only have proxies for these parameters. An estimation of the return on a zero beta asset is challenging. In theory, the expected return on a zero beta asset would be expected to lie between the risk-free rate and the expected market return. More specifically, it should lie between the cost of lending at a risk-free rate and the cost of borrowing. But if borrowing is risky enough, the cost of borrowing could be as high as the market return. In our example, we will use the corporate cost of borrowing as a proxy for the expected return on a zero beta asset. Expressed as an equation, the black capital asset pricing model is as follows. Expected return equals expected return on a zero beta asset plus beta times the expected market return minus the expected return on a zero beta asset. To illustrate the different outcomes from different asset pricing models, let's consider an application. We will compile an estimate for the cost of equity capital for 10 industry indices compiled by FTSE. All stocks are listed in the United States. In an actual application, you might compile your own comparable firm set rather than consider all stocks classified by a data provider in a particular industry. In that analysis, you would need to strike a balance between minimising noise due to random events that impact upon share prices and maximising the relevance of the comparable firm set. Note that in practice, analysts appear to considerably underestimate the estimation error inherent in comparable firm estimation, so generally use too few comparable firms. We will consider some of the more subtle points of estimation at a later stage. For the purpose of the illustration, let's consider the following inputs that were current at the time of writing. The yield to maturity on 30-year government bonds is 3.95%, so we will use this as a proxy for the risk-free rate of interest. As a proxy for the expected market return, we will use the figure of 9.59%, which implies a market risk premium of 5.64% compared to the 30-year government bond yield. The figure of 9.59% for the expected market return is based upon 4 separate approaches for estimating the expected market return, 2 of which are based upon historical information and 2 of which are based upon current signals about the market cost of equity. You aren't expected to reproduce these estimates because the course is not just about estimating discount rates, but you are welcome to ask me individually for more detail about the computations. In the accompanying spreadsheet, I have compiled a set of monthly returns for 10 industry indices. These are excess returns, which means returns in excess of the risk-free rate of interest for that month. To estimate beta, I ran a regression of excess industry returns on excess market returns using monthly returns from January 1994 to May 2013, which is just under 20 years of returns. The reason for using a long time series of returns for beta estimation is because there is considerable noise in beta estimates. Realised returns result primarily from company-specific events, but expected returns under the capital asset pricing model are a function of market-wide risks. So in beta estimation using realised returns, we rely upon having a sufficient number of firms and a sufficiently long time series for random company-specific events to not distort our estimate of beta. It is conventional practice to estimate beta using a shorter time series of returns, often 3 to 5 years. But the estimation error from using a short time series of returns is so large that the beta estimate is no better than a random number. To illustrate the estimate of beta, consider the figure which shows a scatter plot of excess stock returns on excess market returns for the technology index. Each point on the plot represents 1 month and is the combination of the excess return on the market and the excess return on the technology index. According to the line of best fit through the scatter plot, the relationship between stock returns and market returns for technology stocks is given by the following equation. Return on stock I in period T equals the alpha estimate for stock I, the intercept, plus beta for stock I, the risk exposure, times the market return in period T minus the risk-free rate in period T. Incorporating numbers in the equation, we have stock return minus risk-free rate equals 0.07% plus 1.44 times the market return minus the risk-free rate. The beta estimate of 1.44 is the highest amongst the 10 industry indices we will examine. For the other 9 industries, the beta estimates range from 0.41 for utilities to 1.09 for financials. Table 1 presents industry cost of capital estimates according to the capital asset pricing model with regression-based estimates of beta. The cost of equity estimates range from 6.26% for utilities to 12.06% for technology. But these industries are somewhat anomalous compared to the other 8 industries, which have cost of equity estimates within the range of 7.1% to 10.1%. Excluding healthcare, 7 of the 10 industries have cost of equity estimates within the range of less than 2.5%, from 8.4% for telecoms to 10.1% for financials. If we repeat the analysis using the Farmer and French model, we have markedly different cost of equity estimates in some instances. To extend the analysis to the Farmer and French model, we need to make a couple of different assumptions. We need an estimate of SMB and HML, which are analogous to our estimate for the market risk premium of 5.64%. For the purpose of the exercise, we will use monthly average figures for SMB and HML on the basis that we do not have information to inform us as to whether SMB or HML is above or below average at any given time. For the market risk premium, it is possible to use contemporaneous market information to make an estimate of whether the market risk premium is above or below average at a point in time. But there is no generally accepted indicators for whether SMB or HML are above or below average at a point in time. According to historical average estimates, we will use an estimate of 3.55% per year for SMB and 5.01% for HML. To estimate the coefficients on the Farmer and French model, we can perform exactly the same regression analysis as before, but with 2 additional variables in the equation, the monthly figures for SMB and HML. Because there are now 3 independent variables in the equation, we cannot present a scatter plot for illustration. But we can report the regression results for the technology index and compare it to the results for the capital asset pricing model analysis. We have the following relationship. The return on stock I in period T equals alpha for stock I, again that's the intercept, plus the beta for stock I, the exposure to market risk, systematic risk exposure, times the market return in period T minus the risk-free rate in period T, plus the S coefficient for stock I times SMB in period T. So S represents a risk exposure plus H exposure for stock I times HML in period T. H represents a risk exposure just like beta represents a risk exposure. Inserting numbers into that equation, we have stock return minus risk-free rate equals 0.37% plus 1.3 times market return minus risk-free rate plus 0.03 times SMB minus 0.86 times HML. We observe that for technology stocks, the beta estimate has decreased from 1.44 to 1.3, and there is a large negative coefficient of 0.86 on the HML factor. And that is because technology stocks derive most of their value from intangible assets. They have low ratios of book value to market value. So the returns to technology stocks are in the opposite direction to the return on stocks with high book to market ratios. If you were to estimate these inputs, if you were to use these inputs to estimate the cost of equity for technology stocks and make the assumptions that the risk-free rate is 3.95%, the market risk premium is 5.64%, SMB equals 3.55%, and HML equals 5.01%, our conclusion would be as follows. The cost of equity for technology equals 3.95% plus 1.3 times 5.64% minus 0.03 times 3.55% minus 0.86 times 5.01% which comes out to be 6.84%. So to recap, under the capital asset pricing model, the estimate for the cost of equity for technology stocks was 12.06%, primarily due to the large beta estimate of 1.44. Under the Farmer and French model, the estimate of the cost of equity falls by 5.22%, primarily because of the large negative exposure to the HML factor. What is the best estimate for the cost of equity? A difference of this magnitude in the discount rate could very likely lead to accepting or rejecting a project or an acquisition. Also note that for the industry at the other extreme, in terms of the CAPM cost of equity estimate, utilities, the results are reversed. Under the capital asset pricing model, the cost of equity for utilities was estimated at 6.26% due to the low beta estimate of 0.41. However, under the Farmer and French model, the cost of equity is substantially higher at 8.33%. It's 3.95% plus 0.51 times 5.64%, minus 0.16 times 3.55%, plus 0.41 times 5.01%, which comes out to be 8.33%. So for the industry with the highest capital asset pricing model-based cost of equity, technology, including the Farmer and French factors resulted in a reduction in the cost of equity of 5.22%. And for the industry with the lowest CAPM-based cost of equity, utilities, including the Farmer and French factors resulted in an increase in the cost of equity of 2.77%. In all likelihood, the best estimate for the cost of equity will lie between the results from the capital asset pricing model and the Farmer and French model. In reaching a conclusion, you need to recall that the capital asset pricing model has never been verified empirically. Regression-based beta estimates do not have a particularly strong positive association with realised returns. We said the CAPM is biased, imprecise and incomplete. It might be the case that they can do a better model of job in terms of predicting expected returns, but this has not been verified because of measurement problems. Further, the Farmer and French factors are relatively persistent. There is no consecutive 16-year period in which, on average, the HML factor has been negative, and there is no consecutive 22-year period in which, on average, the SMB factor has been negative. So it is unlikely that the positive returns to small, high book-to-market stocks is merely a statistical artefact that is not going to be repeated. Stocks with those characteristics do appear to persistently earn relatively high returns. So if you were to ignore the exposure to these factors in your cost of capital estimation, it is likely that you will ignore a material component of risk. And as we have demonstrated, the differences in your cost of capital estimates can be material under the two equations. On the other hand, there remains estimation error in both the coefficients from the Farmer and French model, that was beta, S and H, and the expected risk premiums to apply to those coefficients, that is the market risk premium, SMB and HML. The dispersion of potential cost of equity estimates associated with the cost of equity for a given firm or industry does not reduce by simply adding more factors to the analysis. While it is likely that the Farmer and French model incorporates proxies for risk that are not accounted for by the capital asset pricing model, it is appropriate to consider that this model also incorporates estimation error. In short, you should not place exclusive reliance on either model in estimating the cost of equity, and the uncertainty over cost of equity estimates implies that your best estimate of the cost of equity lies between the estimates from both equations. It should also be noted that considerable research has been devoted to additional asset pricing models that are worthy of consideration. But for the purposes of this course, we will constrain ourselves to a small subset of models and estimation techniques. Do not interpret our attention to these models only as implying that other models are not worthy of consideration. Table 2 presents industry cost of capital estimates according to the Farmer and French model with regression-based estimates of coefficients. The cost of equity estimates range from 6.25% for telecoms to 13.34% for financials. 7 of the 10 industries have cost of equity estimates within the range of 6.84% to 11.02%. Let's move on to the black capital asset pricing model. One potential reason the capital asset pricing model does not have particularly strong empirical support from realised returns is because investors cannot actually borrow and lend at the risk-free rate of interest, which is an important assumption underpinning the model. The empirical result is that stocks with low beta estimates have actual returns that are higher than expected under the capital asset pricing model, and stocks with high beta estimates have actual returns that are lower than expected under the capital asset pricing model. To repeat, the capital asset pricing model is biased. The black capital asset pricing model has expected returns that align more closely to realised returns in the market. The only difference between the black capital asset pricing model and what we can label as the sharp Lintner capital asset pricing model is that we replace the risk-free rate with the expected return on a zero beta asset. The expected return on a zero beta asset should be above the risk-free rate in theory, so it leads to higher expected returns for low beta stocks and lower expected returns for high beta stocks. The limitation of the black capital asset pricing model is that measuring the expected return on a zero beta asset is challenging. It could lie anywhere between the risk-free rate and the expected market return. For illustrative purposes, we will use the yield to maturity on investment-grade debt as the expected return on a zero beta asset. At the time of writing, Moody's reported a yield to maturity on Baa rated debt of 5.37%. To illustrate the cost of capital estimate for the technology index, we have the following equation. Cost of equity for technology equals expected return on a zero beta asset plus beta times expected market return minus expected return on a zero beta asset. So we have 5.37% plus 1.3 times, all in brackets, 9.59% minus 5.37%, which comes out to be 11.44%. Adopting the black capital asset pricing model means that stocks with a beta estimate greater than 1 will have a reduction in the cost of equity, and stocks with a beta estimate less than 1 will have an increase in the cost of equity. So this will reduce the variation in the cost of equity estimates across industries. Cost of equity estimates across industries are reported in Table 3. 7 from 10 industries now have cost of equity estimates within the range of 8.47% to 9.97%. As with our discussion of the Farmer and French model, we are left with the challenge of deciding on a final cost of equity estimate for practical purposes. Should we stick with the sharp Lintner capital asset pricing model because we can observe something which is a reasonable proxy for the risk-free asset, government bond yields, but which is likely to underestimate the cost of equity for low beta stocks and overstate the cost of equity for high beta stocks? Or should we use the black capital asset pricing model because that model mitigates the risk of estimation error for stocks with very high or low beta estimates, but which introduces imprecision in the measurement of the zero beta return? Or should we introduce the 2 additional risk factors of the Farmer and French model? The most appropriate solution is probably to apply weights to each of the estimates from the 3 models, or additional models if you extend your analysis, based on an assessment of their reliability. We do not need to arrive at specific weights in this class, but this is an exercise which is done in practice. If you attempt to pick one particular model, you will most likely compute some extreme results when applying that model to any particular industry. In Figure 3, I present the cost of equity estimates under each model in comparison to the market cost of equity. If you were to apply the capital asset pricing model exclusively, you would value utilities using a cost of equity which is 5.8% below the cost of equity you would apply to technology stocks. Yet if you were to use the Farmer and French model exclusively, you would value basic materials using a cost of equity which is 7.04% above the cost of equity you would apply to telecoms. What you certainly want to avoid is adjusting your cost of equity estimates purely on the basis of what feels right. Suppose you compile a set of comparable firms and estimate the cost of equity, and then you decide that it cannot be correct because you know that the cost of equity should be something else. If you already know what the cost of equity should be, and this can be justified, just use that number. But chances are that you do not know what the cost of equity is because you have gone to the trouble of compiling the analysis. That is not to say that intuition does not play a role in decision making. Quite the contrary. You should use intuition to question analysis, which leads to unusual results. You just need to take this one step further and find out why your intuition tells you something is not correct. In the previous section, we illustrated how to apply 3 different asset pricing models to estimate the cost of equity. In doing so, we made some assumptions about parameter inputs, namely the risk-free rate, the market risk premium, size and book-to-market premiums, and beta estimation techniques. In this section, we examine some specific issues in relation to these parameter estimates. Let's consider first the risk-free rate. In the previous section, we adopted the yield on 30-year Treasury bonds as an estimate of the risk-free rate. To be more technically correct, we could adopt a separate estimate of the risk-free rate for each year of the project life. This could be done with reference to forward rates, which are the rates at which you can agree to borrow or lend at a future point in time. In most applications, investors simply rely upon the yield on long-dated Treasury bonds to estimate the risk-free rate. For short-term projects, and when the yield curve is strongly upward sloping, it is arguable that a more precise estimate of the risk-free rate is relevant. But the risk of using this technique is that short-term interest rates could well be unusually high or low due to central bank intervention. Central bank activities have more impact on short-term rates than long-term rates. So you could well end up using a more theoretically correct input for the risk-free rate, but which is measured using a proxy with unusual values at a particular point in time. It is also important to estimate the market risk premium in a manner consistent with your estimate of the risk-free rate. Merely deciding to use a risk-free rate estimate from 1-year debt rather than 30-year debt does not imply that market returns next year are expected to be higher or lower. So if you decrease your estimate of the risk-free rate, your estimate of the market risk premium will be higher. Next, consider the market risk premium. One approach is to consider the use of historical market returns. The market risk premium is an estimate of the market's cost of equity relative to the risk-free rate at the time the investment decision is made. The market risk premium is not an estimate of what historical average returns on the market have been relative to the risk-free rate. However, we often use historical average returns to estimate expected returns if we do not have reliable evidence to determine whether expectations are different to what has been observed in the past. In consideration of historical returns, we need to determine whether we are going to use the historical average market return as our proxy for the expected market return, and then subtract the risk-free rate to estimate the market risk premium, which we used in our application, or whether we are going to use the historical average market return relative to government bond yields as the market risk premium estimate, and then add the risk-free rate to estimate the market equity return. In the application in this note, I have computed the market risk premium in two ways, based upon historical average information. Let's first consider the excess returns approach. I estimate the average difference between market returns and 10-year government bond yields using about 140 years of data. This is referred to as average excess returns. On average, the market earned 6.03% above the yield on 10-year government bonds, and the 10-year government bond yield during December 2013 was 2.92%. So the first estimate of the market return is 2.92% plus 6.03% or 8.95%. This means an estimate of the market risk premium based upon the 30-year government bond yield is 8.95% minus 3.95% or 5%. Secondly, consider the real returns approach. In real terms, that is after stripping out the inflation component of returns, the US equity market had earned a return of 8.39% per year over about 140 years. Inflation expectations in December 2013 were about 2.18%, based upon the difference between 10-year government bond yields and 10-year inflation-protected securities. So we could estimate nominal market returns as 1 plus historical average real returns times 1 plus expected inflation minus 1, which is 1.0839 times 1.0218 minus 1, or 10.76%. This means that an estimate of the market risk premium based upon the 30-year government bond yield is 10.76% minus 3.95% or 6.81%. Which is the better answer? The market risk premium of 5% based upon average excess returns, or the figure of 6.81% based upon average real returns? The answer isn't simple, because there are two reasons why the yield on government securities changes. One reason is that inflation expectations change, but the real expected return remains the same. The other reason is that inflation expectations do not change, but real expected returns change. If yields on government securities are low only because of low inflation expectations, then we would also expect the cost of equity to be low because of low inflation expectations. So in this scenario, it would make sense to add the historical average excess return to the current risk-free rate. But if yields on government securities are low for a reason independent of equity market expectations, such as central bank intervention, or because of heightened risk in the equity market, the flight to quality scenario, which leads to a higher cost of equity capital, then it would make sense to use the historical average real equity market returns as our proxy for expected future real equity market returns. To provide some more context, according to data from the US Federal Reserve, on the 31st of October 2008, the yield on US one-month Treasury bills was 0.12%, down from 1.98% just 5 months prior, on May 30th. Does this mean that equity investors also require very low returns to entice them to make investments? No. Risk was very high. They wanted higher returns. This is the most obvious example that we cannot simply assume that low government bond yields means a low cost of equity capital in other asset classes. At the same time, the yield to maturity on Moody's rated Baa rated corporate bonds had risen from 7.06% to 9.54%. The key point is that the use of historical average equity returns, either as a proxy for the market return or as a proxy for the market risk premium, needs to be considered with respect to 1, the level of government bond yields at a given point in time, and 2, the reason why yields are above or below historical averages. In the absence of information to suggest otherwise, it is probably best to use an average of the market risk premium implied by both average excess returns and average real returns as an estimate of the market risk premium from past information. But as discussed below, you should also consider timely signals from the equity and bond markets about the cost of equity at any point in time. You should not perform your analysis purely under the assumption that past returns on an asset class will continue in the future. Let's consider contemporaneous indicators of market returns. Can we identify signals that market returns are expected to be different from historical averages? Yes. There are two ways in which this can be done. First, listed below are 4 market indicators that, directionally, suggest that the market risk premium could deviate from its historical average. Number 1, the term spread, the difference between the yield on long-dated government debt and short-dated government debt. The higher the term spread, the higher the market risk premium. Secondly, the corporate bond spread, the difference between corporate bond yields and government bond yields. The higher the corporate bond spread, the higher the market risk premium. Third, the earnings yield minus the risk-free rate. The earnings yield is the inverse of the price-earnings ratio, and if the data is available, should be based upon forecast earnings relative to price. And finally, number 4, we have the implied volatility of the market. That is the volatility implied by prices of stocks, call options, and put options. These 4 market indicators will not always move in the same direction, and there is no precise relationship between a particular indicator and the market risk premium. But in general, they have been used as directional indicators of the market risk premium. This is not necessarily an exhaustive list of economic indicators of the market risk premium. As an example, I compiled estimates for these 4 market indicators and compared estimates from December 2013 to the history for each estimate. Specifically, we have in December 2013, the term spread was 2.79%, which was the 82nd percentile compared to history. So the term spread was high. The corporate bond spread was 2.53%, which was the 63rd percentile compared to history. So corporate bond spread was relatively high. The earnings yield minus the 10-year government bond yield was 3.49%, which was the 83rd percentile compared to history. Very high. The implied volatility index, or VIX as is often quoted, was 14.19%, which was only the 24th percentile compared to history. So implied volatility was low. So on average, the 4 indicators were at the 65th percentile compared to history, so relatively high. On average, the market return less the 10-year government bond yield was 6.03%, and I assumed that the market risk premium could be plus or minus 3% from the historical average excess return. So I assumed that the market risk premium could lie within the range of 3.03% to 9.03%. And then I compute 3.03% plus 0.65 times 9.03% minus 3.03%, which works out to be 6.95%. Adding the 2.92% 10-year government bond yield means we have an estimate of the expected market return of 9.88%. Then if we take away the 30-year government bond yield of 3.95%, we have an estimate of the market risk premium from current indicators of 5.93%. So to recap, so far we have an estimate of the market risk premium from historical excess returns of 5%, an estimate of the market risk premium from historical real returns of 6.81%, and an estimate of the market risk premium from current market indicators of 5.93%. We can add one more estimate of the market risk premium from equity market signals, an estimate based upon analyst earnings forecasts and the dividend discount model. In short, this is the matter of projecting dividends for the market and then estimating the discount rate, which sets the present value of expected dividends equal to the current market price. For example, Bloomberg publishes a series of market cost of equity estimates compiled in this manner. Bloomberg takes a short-term time series of dividends for each stock from equity analysts, projects growth in those dividends over an intermediate period. Growth rates in the length of the intermediate period vary depending upon whether the stock is classified as high, moderate or low growth. And then in the terminal period, estimates growth as the product of a reinvestment rate and a return on equity. Recall that we earlier used this growth rate equation for equity valuation. In Figure 4, I present estimates of the US market cost of equity compiled by Bloomberg from January 2006 to August 2015. You will note the substantial increase in the estimate of the market cost of funds during the global financial crisis in the second half of 2008, continuing through 2009. Also note that the market cost of equity increased at the same time that government bond yields fell. Investors were selling equities and buying government bonds, which increased the yield on equities and decreased the yield on government bonds. If you were to estimate the market return by simply adding an historical average premium to government bond yields, the estimated cost of equity would have fallen during the global financial crisis, and that doesn't make sense. There are some limitations of the Bloomberg approach which leads to Bloomberg overestimating the time series variation in the market cost of equity. One limitation is that Bloomberg relies upon consensus earnings and dividend forecasts in its analysis, and consensus forecasts adjust to new information more slowly than market prices. This occurs because analysts do not update their inputs instantaneously in response to new information. So when there's a large market move, this overstates the move in the cost of equity because the Bloomberg analysis associates all of that movement with changes in the cost of equity, rather than changes in the sticky earnings and dividend expectations. A further limitation of the Bloomberg approach is that in the terminal state, Bloomberg assumes that the return on equity from new investments is equal to the cost of equity. So Bloomberg assumes that within 20 years, abnormal returns are eroded for listed firms, despite firms currently listed for decades that are still being priced at price-earnings ratios of 15 times. For the purposes of this course, it is more important to understand that techniques exist to estimate the market cost of equity from market prices rather than critique every individual approach. You just need to be aware that cost of equity estimates, even from well-established data providers, can have material limitations. As another example, the Bank of England relies upon a market cost of equity estimate for regulatory purposes. The bank estimates market dividends over 4 years, makes an estimate of long-term growth, and then solves an equation for the discount rate that sets the present value of expected dividends equal to price. The Bank of England approach also has a limitation in that the bank makes an estimate of growth that is independent of market prices. The bank's growth estimate is based upon the potential economic growth in the economy at around about 5% to 6% in nominal terms. And this input is held constant regardless of market movements. If the market falls, that fall could be due to a heightened perception of risk, and so a higher cost of capital, or lower expectations for near-term dividends and long-term growth, and so a lower growth rate. According to the Bank of England approach, all of the market movement will be reflected in changes in the cost of capital. And so this approach will also overstate the variation in market cost of equity estimates from 1 month to the next. Put another way, when there is a large change in share prices, how do we know that this is due to changes in the cost of capital, as implied by the Bank of England approach, in which growth estimates are constant, when we could equally assume that this is due to changes in perceptions for growth and that the cost of funds is equal to an historical average? This point was made by Easton in a 2006 paper. He has written extensively on joint estimation of the cost of equity and growth rates, and he stated that in light of the fact that assumptions about the terminal growth rate are unlikely to be descriptively valid, the inferences based on the estimates of the expected rate of return that are based on these assumptions may be spurious. The appeal of O'Hanlon and Steele from 2000, Easton, Taylor, Schroff and Sugianis from 2002, and Easton from 2004 is that they simultaneously estimate the expected rate of return and the expected rate of growth that are implied by the data. The other methods, like the Bank of England approach, assume a growth rate and calculate the expected rate of return that is implied by the data and the assumed growth rate. Differences between the true growth rate and the assumed growth rate will lead to estimates in the estimate of the expected rate of return. In Figure 5, I present another set of market return estimates that, in contrast to those from Bloomberg, take account of past returns that listed companies have earned on investments. We will not go through the specific computations in the class because, as I mentioned above, we don't just spend all of our time on discount rates. But the key point is that when considering earnings growth, we need to think about reinvestment and returns on investment. Depending upon the assumptions you make about growth, that will influence an estimate of the market return from analyst forecasts and the dividend discount model. And further, do not rely upon an estimate merely because a data provider makes the estimate available. Understand what assumptions underpin the estimate, and if you agree with those assumptions, then use the estimate. If you disagree with the assumptions of the data provider, perform your own computations that are consistent with your assumptions. When providing corporate finance advice, you need to take responsibility for the assumptions. The key point is that in estimating the expected return on the market and the market risk premium, consideration should be given to current market conditions rather than rely exclusively upon historical averages. It is worthwhile to give consideration to historical average because this mitigates the risk that unusual market events unduly impact upon long-term investment decisions and the risk that the estimation process introduces error. In other words, it cannot be guaranteed that either the market indicators approach or the dividend discount model approaches, such as used by Bloomberg or Bank of England, or the better simultaneous estimation approaches also give you the correct answer. But if you rely exclusively on historical average information to estimate the market cost of funds, your valuations will be too high during market crashes and too low during market rises. If you were advising a firm on acquisitions, you would end up advocating acquisitions when the market's perception of risk was high and end up advocating divestitures when the market's perception of risk was low. In the previous section, we considered the standard estimation technique for beta. This is to regress excess stock returns on excess market returns for a set of comparable listed firms. In our case, we illustrated this process with 10 industry indices. In this section, we briefly consider some of the perils of this estimation technique, which is considerably more imprecise than you might expect, given its prominence in practice. To illustrate, consider the beta estimate for an individual listed stock, California Pizza Kitchen. Using monthly returns data from 2000 to 2007, the beta estimate is 0.57 as illustrated in the scatter plot above. The standard error around this beta estimate is 0.3, which means there is a 90% chance that the beta estimate for California Pizza Kitchen could lie anywhere from 0.1 to 1.0. So if your task was to estimate the systematic risk of California Pizza Kitchen, you would not rely only upon this stock. You would rely upon a set of comparable firms. A useful place to start would be a set of US listed restaurant firms. So I compiled beta estimates for 48 US listed restaurant firms using monthly data from 1973 to 2007, which had an average beta estimate of 1.0, as illustrated in Figure 7. So according to this sample of firms, a US listed restaurant firm has approximately the same systematic risk as the broader market. How many comparable firms do you need? This is a standard debate in corporate finance practice. One analyst argues that we need to find a small number of really comparable firms on the basis of product, location, operating leverage, that is the proportion of fixed costs, financial leverage, the proportion of debt in the capital structure, size and profit margins. Another analyst argues that we need a large number of firms because there is a large amount of estimation error in beta estimation. The second analyst is correct for beta estimation. If possible, you need to compile a large number of comparable firms. If the comparable firm set is small, it does not matter just how comparable the firms are to the firm or division or project you intend to value. The estimation error will be so large that you are unlikely to be able to determine whether the business is even more or less risky than the broader market. Consider this statement carefully. Your objective in beta estimation is to determine whether or not there is enough information to conclude that the firm's beta is more or less than the market average of 1. If your comparable firm set is small, even if those firms are almost identical to the firm of interest, there will be too much noise in beta estimation to reach this conclusion. The reason for this is that most of the comparable firms' realised returns are due to company and industry-specific events. We are relying upon having enough firms in the sample for noise amongst the firms to cancel out. So here is one metric to bear in mind. Suppose each one of us in the class form a comparable firm set that has 9 firms in the same industry, according to the 10 industry groups considered earlier. We compile an average beta estimate for our sample of firms and then see how much variation in beta estimates there is across the samples. This is a proxy for how different our cost of equity estimates would be purely on the basis of beta estimation, set aside anything to do with models and estimation of risk premiums. The standard deviation of average beta estimates in the class will be about 0.15. So 2 analysts from the same class would have a cost of equity estimate that differs by about 1%, multiplying the beta estimate by the market risk premium, purely because, just by chance, they happen to select a different set of 9 firms from the same industry. If you increase sample size from 9 to 18 firms in the same industry, the variation in beta estimates across the samples is reduced by about 30%. A standard deviation of average estimates is going to be close to 0.1 instead of 0.15. If you increase sample size again to 27 firms, the variation in average beta estimates across samples is reduced by about 50%. The standard deviation of beta estimates ends up close to 0.08. How much data should you use? This is another standard debate in corporate finance practice. One analyst says to use 5 years of data because the firm could have been quite different previously, so we need a more timely estimate of risk. Another analyst says that we should use 10 years of data because 5 years of data is too greatly affected by company-specific events. It turns out that using all available data minimises estimation error. Both analysts are half correct. Firms do change over time, and so we would expect their true systematic risk to change over time. But the estimation error in beta estimation is so large that truncation of the time series on the basis of timeliness does not seem to improve the reliability of beta estimates. Even though firms change over time, regression-based estimates of beta only seem to have some association with realised returns when beta is estimated using a very long time series of returns. It has not been established that the beta estimate becomes worse when more data is incorporated into the estimate. To illustrate, consider the variation in the beta estimate for California Pizza Kitchen when partitioned into 2 estimation periods. The beta estimate increases from 0.4 to 1.6 despite there being no material changes to the fundamental determinants of beta. What are the fundamental determinants of beta? We generally consider systematic risk to be determined by three components. The systematic risk we would observe if all costs were variable, that is, if every dollar of revenue earns the constant profit margin, so it's not possible to earn a loss. Operating leverage and financial leverage. The first two components combine to form the firm's asset beta, which is an estimate of the systematic risk the firm and the equity would have in the absence of debt. We also call this the unlevered beta. The equity beta, which is also labelled the levered beta, will always be higher than or equal to the asset beta if we layer on top fixed financial claims or leverage, which increases the variation of returns to equity holders. This issue is discussed in considerably more detail in our class on capital structure. For the purpose of this class, you need to consider the equation below, which shows you the relationship between the asset beta, financial leverage, as captured by the debt to equity ratio, and the equity beta. The equation says that equity beta equals asset beta times 1 plus debt to equity minus debt beta times debt to equity. This equation says that as the debt to equity ratio increases, so does the equity beta. This occurs even if there is almost no chance of default on the debt, because the debt holder's fixed claims increase the variation in cash flows available to equity holders. The equation comes from a more general relationship between the cost of equity and the cost of debt given below. The equation says the cost of equity equals the cost of equity for an unlevered firm minus the cost of debt times the debt to equity ratio plus the cost of equity for the unlevered firm. In this equation, RU, cost of equity for the unlevered firm, is the return on an unlevered asset, that is an asset with no debt. If debt is incorporated into the capital structure, the return to equity holders is given leverage, so will increase when the unlevered return is above the cost of debt, which it always will be, and decrease when the unlevered return is below the cost of debt, which is just a theoretical idea. As an example, suppose a business is expected to earn a return of 10% in the absence of debt finance. So the unlevered cost of equity is 10%. The firm then finances its operations with 20% debt and 80% equity, so the debt to equity ratio is 20 on 80 or 0.25. The firm borrows at 7%, so the cost of debt is 7%. In this case, the expected return to equity holders increases from 10% without leverage to 10.75% with leverage. The equity holders benefit from the lower cost of debt finance. The increase in the cost of equity capital is exactly the correct amount to compensate the equity holders for their heightened risk. The equation immediately above holds regardless of the asset pricing model. That is, it holds regardless of whether assets are priced according to the capital asset pricing model, the Farmer-French model, the Black capital asset pricing model, or something else. If you then impose the capital asset pricing model, so the cost of equity equals the risk-free rate, plus equity beta times market risk premium, and you say the cost of debt is the risk-free rate plus debt beta times market risk premium, and you continue on and say the unlevered cost of equity is the risk-free rate plus asset beta times market risk premium, and perform some algebra, the relationship between the equity beta, asset beta, and leverage is shown by the previous equation we discussed. The two equations above are used in corporate finance practice because we often need to make a distinction between the systematic risk of a firm's assets and the additional systematic risk resulting from the firm taking on debt. There are two important issues. First, the firm needs to select a capital structure, the proportion of debt versus equity finance, that it considers to be optimal for shareholders. This is considered in our capital structure class, so we do not consider this trade-off further here. Second, in using comparable listed firms to estimate the cost of capital, we often consider listed firms that have different capital structures to the firm, division or project we are evaluating. So we want to estimate the systematic risk of equity for our firm, division or project, even though it has leverage different to other comparable firms. The standard practice is to assume that firms in the same industry have the same asset beta, or in other words, to assume that these firms have the same cost of equity for the unlevered firm. As an example, consumer goods firms are typically financed with around 20% debt and 80% equity, so the debt to equity ratio is 0.25. We previously estimated an equity beta for consumer goods firms of 0.81. Suppose your firm was considering an acquisition of a consumer goods firm, but this would be financed with considerably more debt than normal, 60% debt and 40% equity. So the debt to equity ratio is 1.5. The systematic risk of equity will be considerably larger than the 0.81 you estimated from comparable firm analysis. For the purpose of this example, also suppose that the debt beta is 0.2. You first need to estimate the asset beta of a consumer goods firm. This is an estimate of the systematic risk of the equity if there was no debt finance. We perform the following computation, which results in an asset beta of 0.688. We say asset beta equals equity beta plus debt beta times the debt to equity ratio, and all of that divided by 1 plus the debt to equity ratio. That comes out to be 0.67. This result says that the operating risk of the 0.69, correction. This result says the operating risk of the consumer goods firm contributed 0.69 to the equity beta, and financial risk contributes the remaining 0.12. The next step is to estimate how much risk equity holders will be exposed to if you finance the acquisition with a different amount of leverage, in this case 60% debt and 40% equity finance. Under this assumption, the equity beta increases to 1.42 as shown below. So the operating risk still contributed 0.69 to the equity beta, but financial risk now contributes an additional 0.732 to the equity beta. So we have equity beta equals 0.69 times 1 plus 0.6 on 0.4 minus 0.2 times 0.6 on 0.4, or 1.42. There is one issue to be wary of in adopting this practice. You need to consider carefully the reasons why you have adopted leverage different from the capital structure of comparable firms. In our example of a leveraged acquisition, we could argue that taking on debt imposes discipline on management to control costs and ensures that surplus cash is used to repay debt rather than being held on balance sheet, and tempting management to make size increasing but not value increasing acquisitions. But in a more general case, if firms have different amounts of leverage, it could be a signal that the firms are not as comparable as you initially expect. We need to make a distinction between the yield to maturity on debt and the expected return on debt. The expected return on debt is lower than the yield because there is some probability of default. The yield to maturity is the return that debt holders will receive in the absence of default, assuming coupon payments can be reinvested at the same yield, which also implicitly assumes no interest rate fluctuations. The expected return is a probability-weighted average of all possible returns. In the simplest case, it is the weighted average of the yield to maturity and the return we would expect in the event of default. So for example, if the yield to maturity was 8%, the probability of default was 2%, and investors expect to lose 50% in the event of default, the expected return is 0.98 times 0.08 plus 0.02 times minus 0.5, which is 6.84%. For estimating the weighted average cost of capital in investment decision making, you should still use the yield to maturity as your estimate of the cost of debt. The reason for this is that the scenario you present to investors or the board will have cash flows defined under the assumption that lenders are repaid. So the investment needs to generate enough returns to shareholders in this normal scenario such that those shareholders are able to earn their cost of equity capital. If you perform your valuation under the lower weighted average cost of capital, derived from the expected return on debt, you could find yourself recommending an investment on the basis that it has a sufficiently high probability of default that it is worthwhile to equity holders. This is unlikely to be met with acceptance from those investors. So we have the first of our valuation rules. In a discounted cash flow valuation, if you have prepared a scenario in which you assume the debt is repaid, which is the normal scenario presented to executives or a board for investment decision making, you must use the yield to maturity on debt in the weighted average cost of capital calculation. In addition, if you are required in some circumstance to use the debt beta in calculations, the debt beta must be computed using the equation debt beta equals yield to maturity minus risk-free rate, and all of that divided by the market risk premium. If you use a lower debt beta based upon the expected return on debt, you will have an inconsistency between your cash flow model and your discount rate, and that will lead to a valuation error. In estimating the cost of debt, we generally refer to the credit ratings issued by Standard & Poor's, Moody's, and Fitch Ratings. There is a high correlation between credit ratings and the probability of default. Table 4 presents historical average default rates for S&P rated debt over the 29 years from 1981 to 2009. The table shows the probability that a bond of a given rating class will incur default within a specified period of time. The bond is in default if it misses just one payment. This is not bankruptcy. For example, out of 100 randomly selected investment grade bonds, you would expect 3 to default within the next 10 years. So the ratings assigned by ratings agencies appear to do a reasonable job of ranking debt issuers and debt issues on the basis of default risk. However, there are limitations associated with credit ratings. The first limitation is that it is not clear exactly how much information is generated by the ratings process undertaken by the ratings agency, in contrast to our purely quantitative analysis of financial ratios. Research has shown that you can compile pseudo-credit ratings with a reasonable degree of accuracy merely through a quantitative screen of the same financial ratios used by ratings agencies. Even market capitalisation alone will lead to predicting more than half of ratings correctly. However, it would be challenging to set up a ratings agency which relied entirely on the basis of such a quantitative screen. For the ratings estimated with error, that is where the quantitative screen does not detect a signal of default risk that human intervention might detect, the potential consequences could be large. So even though a majority of the ratings will be reasonable, the large negative impact from a small number of bad estimates could put the ratings agency out of business. This is one plausible explanation for the market dominance of the 3 ratings agencies. Some regulations require debt issuers to have an investment-grade credit rating before certain investors are able to purchase securities, but this requirement alone does not explain why only 3 large ratings agencies have almost all market share in issuing ratings. A second limitation of credit ratings is that they are not timely indicators of the probability of default. Ratings are based on historical financial information and projections of future financial information. They do not change quickly in response to signals that the probability of default has changed. The rating agencies themselves say that they look through the cycle, meaning that they deliberately hold credit ratings at their current level on the basis that financial information might improve in the future. Furthermore, when a rating changes, there is a better than even money chance that the next credit rating will be in the same direction. This means that ratings only partially adjust to new information about the likelihood of default. One rationale for this ratings agency policy is that the market uses credit ratings as the basis for setting yields on new debt. So a change in the credit rating could alter the cost of raising funds. But this rationale does not give the market enough credit. the market already prices different debt issues with the same credit rating at different yields. So it appears that the market is already able to distinguish between a BBB rated firm that has average default risk and a BBB rated firm that has only maintained this rating because of the stickiness of credit ratings. Furthermore, it has not been established that investors can earn abnormal returns by trading on the basis of credit rating changes. If rating changes were so influential on the cost of debt, and given the stickiness of ratings, we would be able to profitably trade on rating changes. The logic is as follows. We know that a firm has its rating downgraded. On average, the next rating change is more likely to be a downgrade than an upgrade. So if you sell the stock in firms which have had a credit rating downgrade and buy the stock in firms which have had a credit rating upgrade, it has not been established that you can earn abnormal returns from this strategy. This is because the market price of the stock has already incorporated the probability of the next rating change. In short, rating changes generally occur after stock price movements, and only a small amount of residual information is conveyed to the market after a rating change. The stickiness in credit ratings was one reason for the success of a ratings agency known as KMV, which was subsequently acquired by Moody's. The process adopted by KMV to estimate credit ratings was based upon stock price movements rather than financial ratios. The probability of default is determined by market value leverage. The lower the market value of equity relative to debt, the higher the risk of default, and volatility. The higher the volatility of asset returns, the higher the risk of default. KMV relied on an equation known as the Merton model, which implies a theoretical probability of default. Anyone with access to returns and financial information can estimate the theoretical probability of default with this model. The proprietary information used by KMV, and hence its source of competitive advantage, is its database of actual defaults. Firms default on debt much more often than implied by the theoretical probability of default. So you need information on actual default rates to map on to theoretical default rates to accurately estimate the true default probability. To provide some context for the speed with which ratings change over time, Table 5 presents transition rates for issues over periods of 1 and 7 years. On the vertical axis is the initial rating, and on the horizontal axis is the rating either 1 or 7 years later. Each cell shows a proportion of issuers that transition from one rating to another. For example, referring to the upper panel, of all BBB rated issuers at the start of the year, 84% still had a BBB rating at the end of the year. 3.76% of BBB rated issuers were upgraded to an A rating, and 4.13% of BBB rated issuers were downgraded to a B rating. In general, we can say that only about 15% of issuers have a ratings change, either up or down, in any given year. A third limitation of credit ratings is that the distribution of credit ratings across issuers does not respond in a timely manner to changes in market conditions. Over recent decades, there has been a tendency for ratings to be more conservative. For example, an increase in the proportion of non-investment grade rated firms. It is unclear whether this is because the credit quality of issuers has declined or ratings agencies have applied stricter conditions to a given rating. But the key point is that there is not a large decline in ratings prior to periods when there is a sharp increase in default rates. Figure 9 presents default rates over time, showing sharp increases in default rates during 3 recessions, especially for investment-grade debt. We did not observe a corresponding increase in the proportion of debt assigned lower ratings prior to these events. So credit rating changes are not a useful indicator of sharp increases in defaults in the near future. The figure also demonstrates that in practice, you should not price debt or equity securities on the basis of average default rates reported in Table 4 without consideration of market conditions. There is a high correlation of default rates amongst similar rated securities. This has been the subject of legal cases subsequent to the global financial crisis. Some asset-backed securities were priced under the assumption, incorrectly, that the default risks of each underlying asset were independent of the default risks of all other assets. As a snapshot of the financial ratios used by ratings agencies, consider the definitions contained in Table 6 and the median ratios from 2001 to 2003 for different ratings contained in Table 7. S&P ceased publishing a large set of median ratios because it did not want issuers to construct financial statements to achieve particular ratings. The figures reflect the median ratios of firms that were issued a particular credit rating and are not meant to imply that a particular set of financial ratios will lead to a particular rating. S&P actually assigns ratings on the basis of an assessment of business risk on a 5-point scale and then financial risk also on a 5-point scale. The relationship between business risk, financial risk and credit ratings is summarised in Table 8. Moody's and Fitch Ratings also have ratings processes which rely upon a similar suite of financial ratios. It is not particularly interesting to discuss the mapping of financial ratios to credit ratings, so we do not devote a great deal of attention to the mechanics of this process. The key issue is that, for the most part, ratings can be replicated by examination of these financial ratios on an historical basis. The more interesting debate is how much value ratings agencies create by deviating from a quantitative assessment of historical information on the basis of their proprietary process. I already made the point that it would be dangerous to rely exclusively on quantitative metrics, especially based only on historical data, because of the small number of potentially serious errors. But it is an unresolved question as to whether the ratings agency's analysis of industries and the competence of company managers provides useful information, or merely reflects a subjective assessment on behalf of the ratings agency analyst. As you can see, there is substantial disclosure from ratings agencies about the relationship between financial ratios and credit ratings. It is also possible to readily observe the pricing of corporate debt, and hence the yields associated with different credit ratings. So estimating the cost of debt for weighted average cost of capital computations can be done by estimating financial ratios, deriving a pseudo credit rating, and observing the yields on bonds with a similar credit rating and a similar term to maturity. More often than not, there is an upward sloping yield curve, so you should match on both credit rating and term to maturity. Data providers like Bloomberg, Thomson Reuters and UBS facilitate this process by publishing yield curves. The data provider observes the yield on bonds with a particular credit rating and term to maturity and compiles a curve through these data points. So on any given day, you can obtain an estimate of the yield for, say, a BBB rated bond with 5 years to maturity or an A rated bond with 10 years to maturity. There are two caveats to bear in mind, however. First, with respect to the pricing of individual bond issues, trading is much less liquid than in the equity market. So the observed yield derived from a small number of trades has more chance of not being representative of the yield that would prevail in a liquid market. In some cases, bonds may not trade at all on a given day, so the data provider will provide a yield based upon quotes, or even simply a survey estimate of traders. There will be much less reliability in an estimate according to what would you pay for X, as opposed to what someone actually pays for X. Note that the debt markets are very large, but less liquid than equities. During the global financial crisis of 2008, the debt markets effectively closed on some days, but the equity markets continued to function. There was no market failure of equity markets. Price falls don't represent a market failure. They represent revised expectations. Second, yield curves are based upon a combination of bonds with different credit ratings and terms to maturity. For example, the yield curve for BBB rated 10-year corporate debt is not only based upon bonds with a BBB rating and 10 years to maturity. Bonds with a longer and shorter term to maturity are used, and bonds with different credit ratings are used in order to obtain a sufficiently large sample. So different data providers have different yield curves because of differences in sample composition and different algorithms to determine what the best relationship is between yield, rating and term to maturity. So let's turn to another of our valuation rules. In estimating the cost of debt for a business, if you have information on its actual borrowing, this is the most relevant information. Otherwise, if the firm has a credit rating, you can estimate the cost of debt based upon firms in the same industry with the same credit rating, or something close to the same credit rating. But bear in mind that ratings changes are sticky. The ratings agencies deliberately do not incorporate all recent information into credit ratings. So you may need to adjust the reported credit rating up or down by referring to recent information. If the firm does not have a credit rating, you can construct a pseudo credit rating with reference to financial ratios, or apply the Merton model or something similar, which incorporates the value of the business or a proxy for the value of the business, which, as we've talked about, cannot be book value, and volatility. In this course, we do not cover the Merton model and similar models, but you should be aware that they exist and they provide a useful, timely way to estimate credit risk.